So the moneyness at the date of maturity is a strike price. It's underlying price minus strike price.
Okay, now walk me through your optimal decision, please. So the strike price is 175.
Yes.
What does the call option give you the right but not the obligation to?
Well, the call option gives me the right but not the obligation to buy the underlying at a strike price $175 on or before the December 2017.
No.
I'm sorry. On or before the December 29th, 2017.
Okay, so
yeah,
then so now at 12:29, what happens at 12:29?
Well, I choose not to exercise the option.
Why so?
Because the strike price is the underlying price is below the strike price, so I have the right but not the obligation to exercise the option. So I choose not to exercise it.
Excellent, very good, Edie.
Thank
now,
you.
Let's see, who can I call on? Rundan. Yes, please explain row 12.
Row 12.
I can't hear you.
Okay.
I cannot hear you.
I'm sorry. So, Professor, can you hear me?
Barely. By the way, Hanshu, your camera is pointing to your ceiling. I cannot see you.
Okay, Professor, can you hear me? Hello, Professor.
You're very faint.
I'm sorry, but I don't know where is the wrong place.
Okay, let's continue. Let's concentrate really hard on what you're saying. Shing, can you hear Rundan? No, I can't hear you.
You can hear me?
I can hear you. Yes, I can hear you.
Okay.
Can you hear Rundan though?
Yeah, we as long as we have concentration on the voice. Yeah.
Okay. All right, Rundan, go on. Go on. Okay, the reason, while we're waiting for Rundan to put her headset on, the reason I kind of emphasize these steps is there is absolutely no reason to try to memorize things, okay? Finance is all about facts and logic, not about memorization. When you do these things over and over again, they become second nature to you and you don't have to go through these steps every single time. But implicitly, you need to be going through these steps every single time so that you don't make mistakes. One thing that I've learned the hard way, you try to think too quickly, you will make mistakes. And really, I've been in academics and in consulting for a very long time. There is very rarely a situation where you have to think very, very quickly. Most of the time, you have to think deeply. All right, so go through steps. If something strikes you as not quite right, you might be right that there is something wrong there. Okay, so feel free to jump in and say, that doesn't strike me as right. All right, Rundan.
Okay, so Professor, can you hear me?
Yeah, let's go. Continue.
Okay, so in the row 12,
the underlying price at maturity is 180, and the strike price is 175. So the underlying price at maturity is larger than the strike price. So the numerical moneyness is $5.
Okay. All right. And as you can see, at maturity, thank you very much, Rundan. It's at, who wants to walk me through row 7? Hanshu.
Sorry, Professor. I just go to the toilet because my body is not that healthy right now. Sorry.
Sorry, I couldn't hear you.
Yeah, can you hear me now?
Yes, I can. Yeah.
Oh, sorry. Because my body is not healthy right now, so I just go to the toilet to deal with my health. Sorry.
I'm sorry, I couldn't understand you. All right, somebody else who wants to go? Kai Shu. Please walk us through row 7.
Because the strike price is the same as the underlying price at maturity, so I will do nothing.
What do you mean you'll do nothing?
I will keep the option.
Why not? What do you mean keep the option?
Hold it. I will not sell it, or I will not exercise it.
At 12:29, the option expires. So what's the meaning of holding it?
Oh.
You can either exercise it or let it expire.
Let it expire. Well, if I exercise, I think because my payoff is 0, right?
All right, Mimi Sheng, please walk us through row 7. Mimi?
Yeah, I'm here, Professor.
Okay, please walk us through row 7.
Row 7? Yeah,
Please walk us through row 7.
Okay. Right now we know strike price and the underlying price, that's the maturity are same, and the payoff is 0.
No, what are you going to do? So what's the decision?
We have right but not the obligation to buy the underlying, so we can exercise it or not.
So what are you going to do? Are you going to exercise it, or are you going to let it expire?
I think it's indifferent to.
Right.
Yeah.
Exactly. Those are the two choices. Not holding the option because the option is expiring. You have two choices: either to exercise the option or to let it expire. And if under row 7, if the underlying price is $175, that is to say, if the option is at the money, then you are indifferent between exercising the option or letting it expire. So this is an at the money option. So the numerical moneyness, as we have described here, is equal to underlying price at maturity minus strike price. So the numerical moneyness is -5, and it is out of the money in the first few rows. And excuse me, then it is 0 in the middle, which you just walked us through, and then it's positive going forward. Now this mid, so the mid bid ask, that's something we got from the actual data, is the price of the option 1.715. So what's the net payoff to the long call at maturity? The payoff, remember here it's in row 2, it's $0, but you had to pay $1.715 to buy the option. That's the price for the option. That's the premium for the option. So the net payoff is negative $1.715. That is equal to H2 minus L2. So that's the net payoff of long call to maturity. Similarly, right at the bottom, the payoff to call to long call at maturity is $5 minus the price you paid, which is $1.715. The net payoff is the payoff minus the option premium or the option price. So the net payoff is $3.285. In exactly the same way, we will do the option for put prices. So in this case, for a put option, you have the right but not the obligation to sell. Remember, this is an American option, so you have the right but not the obligation to sell at the strike price between now and the expiration date. So let's say at maturity, the price, once again, as I've done it before, so these prices are all real prices. The underlying price to maturity, I've simulated at $1 intervals from $170 to $180. And just like we did with a call option, it's the negative of that for put option. And you calculate it in exactly the same way. That gives you the payoff of long put option at maturity. Excuse me, let me go back to options, call options. So we did the payoff to long call at maturity. So the flip side of it is the payoff of short put option at maturity, which is the person who sells the option. So it's just the opposite of the payoff of long put option maturity. This is a zero-sum game. It's a transaction between two people. One person's loss is the other person's gain. There is no variable sum situation. So it's just the opposite of that. So what is the underlying price at maturity, if it is $170, then the payoff of long put option at maturity is $5. The price of the option is 67 cents. Remember, when you're buying the option, you have to buy that, you have to pay that. So the net payoff of the long put option at maturity is the payoff of the long put maturity, $5 minus this price that you pay, which is equal to H2 minus P2, long payoff of long put option at maturity, $4.32.
So, Professor, are we gonna make the decision like based on net payoff or the payoff?
Net payoff, because sorry, what decision are you talking about?
I mean, like,
which decision? To buy the option to begin with, or to exercise the option at maturity? The two.
To exercise the maturity.
You tell me the answer.
I guess it should be net payoff.
Why? Does it matter? Because the price you have already paid at that point. It is the sunk cost from microeconomics.
Oh, okay. Okay. So like, if I'm if this is my first step, let's say to buy either buy or not buy the option, we need to consider in the net payoff. Otherwise, we'll note on the payoffs.
Excellent.
Okay.
Does
Good.
everybody understand? That's a very, very good point that Xing raised, which is when you are deciding whether to buy the option or not, what comes into play is the net payoff. However, the decision whether to exercise or not, at that point, the net payoff, the price that you pay has already been paid. It's sunk cost. It doesn't matter. All that matters is the payoff, and that is the comparison, as we just did, between the strike price and the underlying price at maturity. Very good. Any questions?
Yes. What's the protective put as opposed to the put option?
Sorry, could you repeat that?
What is the protective put like in column J?
Okay, we'll get to that. Very good question. We'll get to that in just a second. So now the first portfolio that we saw is a covered call, which is long stock, short call. So let's go to the next portfolio spreadsheet, which is option portfolios. So let's make sure we understand the various columns. So we're talking about options that are being purchased on 12/26. They expire on 12/29. Strike price is $175. The underlying maturity lies between $170 and $180. This is the price of the call option. Column F is the price of the put option. Then payoff of long call option at maturity. Then the payoff of a short call option at maturity, which is just the negative of that. Payoff of long put option at maturity, which is what we calculated earlier. Payoff of short put option at maturity, which is just the negative of that. Okay. Long covered call. What is covered call again? Covered call is, as we have discussed, long stock, short call. Long stock, short call. So you get H2, which is short call of maturity, plus D2, which is the underlying price of maturity. You have to pay the short call option. That's the payoff that you get when you buy the option, plus you get the underlying price at maturity. All right, that gives you the payoff of the long covered call at maturity. Okay, do you understand this portfolio? Okay, can you hear me?
Yeah.
Okay.
Yeah.
Yeah, my speaker, suddenly you all went silent. I'm like, you're a silent people, what's going on? All right, so so the K then gives you the payoff of the long covered call at maturity. What is the net payoff? Net payoff is this K2. Remember, you are short the stock. That is to say, you have sold the stock. That is to say, you will get the price of the stock. You will get the option premium. So therefore, where is the price of the option premium? $1.715, which is in column E. So therefore, the net payoff of the long covered call at maturity is the payoff of long covered call at maturity plus this option price E2. So you go down this and we get the net payoff of the long covered call at maturity is given by your column L. So go back to our that here is long covered call. So I plot on the vertical axis is the different prices, and the payoff of the orange is, sorry, the blue is the payoff of the long covered call at maturity, and because you're actually going short on the call option, that is to say you get paid, so net payoff is actually higher than the payoff of the long covered call at maturity. So this gives you the payoff diagram of the long covered call. Now going back to our option portfolios, the net payoff, the payoff of the short covered call at maturity is given by M. Then the net payoff of the short covered call, in this case, when you are you're on the short side of the covered call, it's a negative of the negative. That is to say, you will have to pay the option premium, the option price. So this E2 is actually subtracted from M2. And so as a result, the net payoff of the short covered call at maturity is lower than the payoff of the short covered call at maturity. So because this E2, which is the price of the call option, is subtracted from it. So what does the payoff diagram look like? A short covered call you have different maturities on the horizontal axis. Then the payoff of the short, the net payoff of the, sorry, the blue line gives you the payoff of short covered call at maturity, which is the blue line, and the orange line in this case is below the short covered call at maturity. The difference between the two is the price of the option, which you, since you're taking the short position in this covered call, you will have to pay. Let's now go back to the lecture slides. All right, so Gail, what you were asking is this protective put. It's if you're doing options trading, this is one of the things that comes, excuse me, over and over again. It's what we would call an insurance strategy, and the portfolio is long stock, long put. Okay, and it's to the obtain is in case there is a down market in the underlying, then this put option provides a bound on how much you would lose if the market goes south. Okay, so that's the idea of a protective put. Now let's make sure we understand how this portfolio, the protective put works. So going back to our Excel spreadsheet and go to the option portfolios spreadsheet. And we have done the, now go to column O. Gail, as you wanted to know, this long protective put at maturity, once again, is long stock, long put. So I2, which is the payoff of the long put option at maturity, plus D2, which is the underlying price at maturity. Remember, long stock, long put. So D plus payoff of long protective put at maturity is the payoff of long put option at maturity plus the underlying long put, long stock. So that is the payoff as we would calculate, simply based on all these payoffs for different values of the strike price at maturity. What is the payoff? Long stock, long put. That is to say, you will have to buy the put option, which is to say, you will have to pay the price of the put option. You have to pay the premium, the option premium for the put option. So how do you calculate the net payoff? In this case, you will take the payoff, subtract from it the option price. So how are you going to get the net payoff? You're going to subtract F2 And what is F2? F2 is the price of the put option, the option premium for the put option. So so what is the net payoff of the long protective put? Equals O2, which is the payoff minus the price of the option. So to go to when we plot it on the diagram, it looks like this. The payoff is the blue line once again. The payoff gives you the long protective put at maturity, and it has this very nice hockey stick look. And the net payoff, which is the subtraction from that of the option premium for the put price. Okay, that's the difference. In this case, the net payoff is lower than the long protective put. What is the payoff in this case? Can somebody, okay, Gail, since you were interested in this put option, can you see the insurance side of this?
Yes.
Okay, walk us through it.
Well, looking at the graph, you can see it's more flat than the other ones. And on the left side of the graph, it doesn't go.
Exactly.
It doesn't go lower than a certain point.
Right, exactly. Now, if you had only the underlying, it would go down straight. It would straight line. This flattening of the curve would not happen to the left of the diagram, right?
Yes.
Yes. So, which is why, you know, when you start doing your financial planning, always ask about this protective put. Okay. If there is one thing you are going to take from this course is understanding this protective put. It is really a very, very useful insurance strategy. Simple, but very helpful. Okay, any questions? All right, so of course, when we do the net payoff of the long protective put, the other side, somebody is selling you this protective put, right? So you have to understand it from their perspective as well. So remember, you know, so Gail, if you and I are doing this transaction, whatever I'm making is the opposite of what you're making. So, you know, at some point, both of us, it has to be in our interest to make this transaction, which we started off right at the beginning of this course, is the price at which, you know, my value is the price at which I'm indifferent between holding, selling, or buying, right? So, both sides, we have to understand the incentives of both sides in order to make this happen. So what is the payoff as the short side? It's just the opposite. The negative of the payoff is the long protective. But when you're doing the short protective put is, remember, it is the payoff plus, in this case, remember, it is long stock, long put. So you will have to, the short side actually gets the price of the option. So F2, the price of the option, has to be added onto it. So the short protective put operates in exactly the opposite direction. The blue line gives you the payoff of the short protective put at maturity. The orange line is the net payoff of the short protective put at maturity, which is exactly higher than the payoff, simply because you are on the short side of an option. That is to say, you're selling the option, so you get paid the option price. Any questions before we move on? All right. I'm going to go back to the slides now. And next thing is a straddle. A straddle here is a portfolio consisting of a long call and a long put with the same strike and maturity. Okay, nothing about the underlying. It is to say, I'm going to buy. You know, it seems like you're really covering your bases, right? How exactly is it going to work? And this is the straddle is a fascinating piece of financial engineering. Long call, long put. You buy a call option, you buy a put option. All right. How exactly is are the payoffs going to work? Once again, let's go to the actual data and go to so long put, long call. So it is equal to the payoff to the call option. So what is the payoff? Payoff to the call option plus payoff to the put option. So equals G2 column G, which is the payoff of the long option, and column M, which is the payoff of the, sorry, where's the put option? Yeah, so column G, which is the payoff of the long option, long call option, column G, column G, which is the payoff of the long call option, column I, which is the payoff of the long put option. It's the sum of those two. So what is the payoff of long straddle at maturity? Equals G2 plus I2. So here it is. At the, when the payoff of when the underlying price, when the underlying price is $170, you know what? Hold on for a second. Okay, so the payoff of the long straddle at maturity equals the payoff of the call option plus payoff of the short option. So when the strike price is $175, the payoff is $5. When the strike price is when the underlying price is 171, the price is $4. So it's $5, $4, $3, it goes down to zero. And then when the strike price goes up further, it starts going up again. Now, what is the net payoff of the long straddle at maturity? Net payoff. This is, remember, long put, long call. Yep. So you have to pay the prices of the put call and the put option and the call option. So to buy a long straddle, to go long at a straddle, you have to pay the price for the call option as well as the put option. So what is the net payoff then? It's S2 minus E2 minus F2. You have to pay the price of the call option as well as the strike option. Both of those have to be subtracted. So this gives you the net payoff of the long straddle at maturity. So if we were to graph this, it will look like this. So in this case, as you can see, I'm not being able to see you, which is a bit, hold on for a second, okay? Yeah, well, can you hear me though?
Yes.
Okay. Okay, and you can see me. Yeah, can you see your classmate?
Yes.
Okay. I'm not being able to see you, which is a bit unfortunate. So you won't be able to see yourself in the videos either. All right, we'll work with it. All right, so so this here is the net payoff is substantially lower because the difference between the blue line and the orange line is the sum of the call option price and the put option price. So that's why this long straddle net payoff is substantially lower than the short than the payoff. Okay, so what therefore, remember, this is a unique balance. You're buying one put option, one call option with the same strike, and so the farther out the price is at maturity from the mean, the better your payoff. Okay, so the long straddle is what we call a pure volatility play. You get your money when you have more volatility. If you think there is going to be substantial volatility in the market, that's when you should go long on a straddle. So when an investor buys a long straddle, this is what we call a view. The view of the world from that investor's perspective is that of higher volatility in the market. It's not about growth. It's not about net prices. It is about view of the volatility. So this is the long straddle. Let's go back to our options portfolio. So the payoff of the short straddle at maturity is exactly the negative of the payoff of the long of straddle at maturity. But in order to get the net payoff of short straddle at maturity, you now have to add on the prices of the put option as well as the call option. Because when you are shorting a straddle, when you are selling a straddle, you are selling a call option and selling a put option. That is to say, you get paid the call option price and the put option price. So we would have to add on, when we take the payoff of the short straddle at maturity, which is column U, in order to get the net payoff, we will have to add on the prices of the call option and the put option to get the net payoff of the short straddle at maturity. So when we when we plot the diagram, the payoff diagram now looks like this, which is to say, it is at its peak, at the kind of central tendency, at the mean of the distribution of prices at maturity, and the farther out it goes out, more volatility there is, the lower the payoff. Now, once again, with short straddle, the net payoff, the orange line, is higher than the blue line, the payoff line, because the difference between the two is that you are getting paid the prices of the call and the put options. So therefore, the orange line is higher than the blue line. And this difference is exactly the prices of the two options. So this here is the payoff diagram for the short straddle. Now, remember, the long straddle is, exactly, the negative of this. To get the short straddle, you do the other way around. And one thing to keep in mind is, when this transaction takes place, the prices are determined by the fact that both parties are willing and able to enter into this transaction. So therefore, it is always important to remember that the prices will be determined by the situation where both sides have different views of the risk and expectation, and that's how these prices are determined. So please keep that in mind. Let's go on to back to our slide, and let's talk about so the short straddle, as it says, the straddle is shorter call and put with the same strike and maturity. Now the thing to keep in mind here is a short straddle is clearly a short volatility position. All right. So that's where you're betting that the position will not be, the underlying distribution will not be volatile, because if there is a price increase, you make losses on the call. If there's a price decrease, you make losses on the put. Now, Barings Bank, it's a very interesting situation. So we'll just quickly go through this case study. Okay, so derivatives debacle in the 1990s was of Barings Bank. So and it was $618 million that capital that it had was completely destroyed in just a very short period by losses in excess of $1 billion by one individual, Leeson, operating out of Barings' Singapore office. So, and that's it. Long futures and short straddles were involved to make this happen. All right. So what was Leeson supposed to do? He was supposed to engage in arbitrage trades that exploited short-lived differences in the Nikkei futures prices on the Osaka and the Singapore exchanges. So the mandate was don't take much risk and no directional exposure. So, but the thing was, he was explicitly forbidden from taking proprietary positions. And we have talked about this before, about the differences between proprietary positions and agency positions. And so that's what he was supposed to do. What he ended up doing is, in violation of his mandate of what he had been ordered to do, he took on proprietary positions in both futures and options. So, but the problem was he was making losses, but he was lying to his bosses in London that he had made huge profits. Now here I am. I've run large organizations and large teams where I'm responsible for profits. Anytime that I see somebody who's making 50% of profits, I should be very suspicious. Suspicious is another word. You need to do your due diligence. So, but that's what these people did not do. So just look at this year. In 1993, he reported a profit of $14 million when his actual profit was a loss of $33 million. In 1994, he reported a profit of $46 million, where in fact he lost $296 million. In 1995, he reported a profit of $30 million, whereas in actuality, he lost $1 billion. Okay, now, Yu-Cheng Zhao, can you please tell me what, if you were the boss and you see somebody making these huge profits, what should you be doing?
If I see making huge profits, I will think there may be something wrong within it.
Maybe it's perfectly fine, right? But you need to investigate. Yeah. You need to investigate. That's why you are the boss. It's your job to make sure everything is going correctly, right? Very good. Very good. And that's the problem. His bosses were so happy, and they were frankly lazy. Some people have even accused their bosses of getting profits on the side. They were being paid bribes, so to speak, to keep quiet. It is an absolute collapse of corporate control. Thank you. That was very good. So look at the holdings he had. In February 1995, against Barings' capital of $615 million, his notional holdings were $33 billion. $33 billion. Just look at it. About 50 times what Barings' total capital. That was his notional holdings. And reported holdings of 30,000 of Nikkei 225 futures. His actual holdings were 61,000. Japanese government bond futures, he reported a holding of 15,000 positive, whereas he actually had a short position of 28,000. It is staggering the level of corruption. How did he get away with it? Two factors. first, as we were talked about it, ridiculously poor controls. He was not only the trader, he was the one who was actually filing the reports. How can you have that? The same person doing the trade and the same person filing the report. And the cross trade, because cross trade is where I am the same company, the same firm is a party to itself. So you don't realize, because it's plus minus and negative, things cross out. So you're not realizing. All you see is the net number, which is close to zero. You don't see how big the positive is and how big the negative is. Remember what counterparty clearing that Adam Hofstetter was talking to you about? That's precisely the kinds of risk management that is definitely a part of modern banking today. And the Barings situation was a large part of why these modern controls have come into place. All right, so now, even though he wasn't allowed, he took on these massive option positions, which was effectively selling straddles. So he was heavily short on straddles. So now the Nikkei was quite flat. Remember, what is a straddle is an option play. A long straddle pays off in a volatile market. A short straddle pays off in a non-volatile market, in a flat market. So in the early part of Leeson's tenure, the Nikkei was quite flat, and so it went off perfectly. And if the Nikkei had stayed in that range, his payoff would have worked out, but it did not. In January to March 1995, the Nikkei fell down quite drastically. Why is that? The Kobe earthquake happened, and it went from 1935, it took down, and so on. And yet, even though on Friday 17th, the market is going down, Leeson bought an additional 10,800 shares. And this is where, when crooks, they're like, okay, I'm going to prison anyway. Let me, what we call in America, a Hail Mary pass. Like, all right, and if you know American football, this is one of those things where the thing is like, I'm going to throw the ball as far as I can and hope to God it reaches the other line. If you're soccer fans, this is one of those back kicks that they, from one end of the field to the other end, just a huge kick, and hoping to God somebody is going to kick it into the goal. So that's a Hail Mary pass. It was an attempt to manipulate the risks. What happened? So by Monday, January 23rd, the Nikkei lost over 1,000 points, closed below 18,000. Huge losses on the long futures position. So double or nothing, yet another, pure gambling. You're like, okay, the only way I win this one is by taking a huge risk. So I take that risk. Increase his long futures, even worse. The Nikkei kept going down. What happened? Barings went bankrupt. The once proud bank was finally bought for £1. Who was to blame? Of course, Leeson. But, and this is the part that we talk about, and which was very correctly pointed out by you, the main lesson was the importance of controls. That if you have a trader, you need to have these controls, the supervisions, etc., in order to make this thing work. All right. So, and so this is in 1995, 25 years ago. Today's markets, you would say that there are significantly better controls. Of course, you will point back to me and say, "Hi, how did 2008 happen if these controls were all better?" No, that was also clearly a failure of all kinds of controls in the financial market. But what we see now is significantly better given these things happen. All right, I'm going to open. Okay, any questions before we move on to a different set of slides?
No.
Professor,
Yes.
can you hear me?
Yes, I can.
Yeah, it's Xiaokang.
Yes. Hi, Sharkan.
Hi, I'm good. So I have one question about so does it mean we have the insurance if we follow the option portfolios, and we will just make money as a Excel worksheet shows?
Correct. Exactly. Different of these portfolios have insurances against different parts of the different parts of the underlying movement. As Gail and I were discussing earlier, what you have with the put option, the protective put is insurance against the option going down. Yeah. So not the option. Sorry, my bad. The underlying going down. A straddle is a volatility play where you make money if the underlying turns out to be more volatile. Okay. So all of these portfolios have different roles to play, and they are optimal given different views of the future of the underlying security.
Yeah. Okay. So if many people know the principles of the options, so they will all make money in the portfolio market or in the option market, and yeah, I mean the hedge fund. What does the hedge fund does? Yeah.
Okay, I'm not following your question. What does the hedge fund have to do with this?
So, from my point, maybe some hedge fund will do some portfolios of like the maybe long call, word call, or maybe some other portfolios, so that these portfolios can make sure that they will make money or make profits in the real world.
What is so special about a hedge fund as opposed to any investor?
It's just an example. I just want to see that if I know the principles of the option portfolios, I will always make profits in the real market. So
no, absolutely not.
Okay.
It's a risky situation to always, there is no such thing as a free lunch. When you're in finance, you have to understand that there is always a possible probability of making a loss. Otherwise, why would the other side sell to you? You're never
so it's not a real insurance for us.
Well, it is part of the insurance. You're paying for the insurance. The put probability covers your call. But that doesn't mean if you're going to have to pay for it. So there is the negative. The payoffs can be quite negative.
Okay.
Yeah, because premiums you're paying the premium. Remember, the protective put, you have to buy the put option, so you have to pay the option premium. So you can absolutely lose money on it.
Yeah.
Okay.
Got you. Yeah.
Okay. Very good. You're welcome.
Professor, I had a question on the case study. So, in the case we had Leeson sold the $6.5 billion short options to Nikkei.
Sorry, what was your question again? Could you repeat that, please?
The question is, if Leeson sold $6.5 billion short options to Nikkei.
No, he sold straddles. He was short.
Oh, straddles.
Right. So he sold put options and call options.
Is that all short?
He sold them, so yes, he was short on them.
Okay. So if that short straddles, that they would benefit if the market is stable, right?
Correct. Exactly. Exactly. Very good.
Oh wait. So as the market, if the Nikkei goes down, they would. Oh, okay. Makes sense now.
All right. Excellent. Okay. So let's say we go to a slide, your lecture notes F.03, and let's make sure we understand the notations. K is the strike price, T is the maturity date, S is the current price of underlying, ST is the currently unknown price of the underlying on date T. So option prices, CA and PA are American call and put. CE, PE are European call and put. And if a property holds for both American and European options, we simply call it just C or P without the subscript. PV of X is the present value of an amount X receivable at T. Okay, these are the bounds on the call prices. The upper bound is that a call price is always less than or equal to the strike price. What are the lower bounds for European calls? The call price of an European option is always greater than or equal to 0. And also it's always greater than or equal to the current price of the underlying minus the present value of the strike price minus the present value of the stream of dividends. Okay, if you want to understand the logic behind all of these, please read through the notes carefully. Feel free to call me, feel free to email me, and I'll be happy to walk you through why these things happen. But the lecture notes are pretty clear on why all these happen. The lower bounds for American calls are that the call price of an option is always greater than or equal to 0. You can never have a negative price. Also, the call price of an American option is greater than or equal to strike price minus the price of an American call option is greater than or equal to the underlying price minus the strike price. Okay, and finally, like we had earlier, the price of a call option is greater than or equal to the underlying price minus the present value of the strike price minus the present value of the stream of dividends. What are the similar bounds on the put prices? The upper bound is the price of a put option is less than or equal to the strike price. Not surprisingly, the price of a European option is greater than or equal to 0. And the price of a European option is greater than or equal to the present value of the strike price plus the present value of the stream of dividends minus the underlying price. For American puts, it is price of an American put is greater than or equal to 0. The price of an American put is greater than or equal to strike price minus underlying price. And the price of an American option is greater than or equal to the present value of the strike price plus the present value of dividends minus the underlying price. Once again, please read through these notes and I'll walk you through some data in just a few minutes. Okay, so going back, okay, Jiatang, you were the one who were asking about the insurance, right?
Yes.
Okay, so this is precisely for you. The insurance provided by the call is that consider these two portfolios, long call option and the long underlying and short call. The only difference is if the underlying price at maturity, ST, is greater than or equal to strike price, the two portfolios have identical payoffs. But if the underlying does not do that well and ends up at maturity to be less than strike price, then the portfolio A, the long call option, is not exercised, so its value of 0. but the portfolio B has a negative value of ST minus K. That is the obligation. So portfolio A protects against a fall in the asset price. All right. Whereas portfolio B is not. All right. So difference between why would you do a call rather than invest in the underlying directly? And the difference is if the price falls below the strike price, then you are not obligated to exercise your option. Whereas if you were in underlying, you would have to follow through. This is the insurance. Okay.
Yeah, that makes sense.
Yeah. Now remember, on the other side of it, when I am paying for my auto insurance or my life insurance or my health insurance, people who are selling it to me, they are also making money. All right. So it is an idea of risk arbitrage. Something you should absolutely always keep in mind is that nobody is doing it without wanting to do it. All right. So the only reason it would make sense for other people to do it is if it's in their interest to do it as well. All right. So what is this insurance value? Going back to it. So you have a portfolio A, which is the long call option, and B, which is the long underlying and short cash. This is indeed the insurance value. The value of the call option minus, instead, what could you be doing? You could be investing in, take the same amounts and investing in the underlying, in which case you have the underlying minus the present value of the strike price minus the present value of the dividend. That precisely is the insurance value, which is always greater than or equal to 0 from one of the inequalities we saw earlier. Analogously, the insurance value of a put is given by the price of the put minus that. And once again, the insurance value is always greater than or equal to 0, following from the inequality that we did earlier. Okay, so we are going to rewrite this as the insurance value expression. We're going to rewrite this as the price of the call option equals S minus K. Remember, what is that? That's the intrinsic value. All right. That's the moneyness that we have discussed. Now, do you understand why we talk about this as the intrinsic value instead of taking the maximum of this and 0 to get this decomposition? I cannot see all of you. All right, so listen, as I said, at 12:15, we will have our guest speakers joining on. So I will actually drop this conversation at 12 o'clock and start up again in a short while because I cannot see all of you, and that's kind of unfortunate. Okay. All right. So so can you see now why S minus K is intrinsic value? So K minus PVK is the time value, interest savings from deferred purchases, because PVK, the present value of the strike price, which is something you're going to have to pay in the future. So that difference is positive. And the insurance value is the downside protection. Correspondingly, the insurance value of a put option is given by the bottom expression over there. So once again, we have the decomposition of put value. The put value equals intrinsic value minus the time value plus insurance value plus the present value of the dividend. So the decomposition, and this might be the most important slide in this course, is that a call price is intrinsic value, any option price is equal to intrinsic value plus time value plus insurance value plus the impact of payouts. Now, what does it all mean? It's ceteris paribus, it's better to start more in the money. The more the intrinsic value, the better off it is. The call gives you the right to buy the asset for K and date T. You could buy it today at K. On the other hand, you could buy it on date T for K. So that difference is the time value, because K a year from now is worth less than K today. If the price of the underlying falls, and that is Giacomo, as you were asking about the insurance, If the price of it falls, we can just say, bye-bye, we're gone. That is the insurance value. And of course, the impact of payouts. The interpretation for put options is exactly the opposite. Most of us understand call options better than put options. So that's why I've spent more time on the call option. But in the put option is exactly the same interpretation. All right, what is the intrinsic value? Once again, is moneyness. Time value is affected by interest rates and maturity, and insurance value by volatility and maturity. These observations can be used to gauge the qualitative impact of interest rates, time to maturity, and volatility. Later on, when we do Black-Scholes, we'll see an explicit formula based on these different factors, but you can already see how this all matters. And finally, what is this decomposition? You know, for deep in the money option, you have the intrinsic value is much greater than the time value, which is greater than the insurance value. Okay, deep in the money, because you're already likely to make a lot of money. So that then dominates the time value that we have talked about. The fact that you're having to pay the strike price later dominates the insurance value. However, if it is the other way around, but if it is a deeply out of the money, the only reason you would buy a deeply out of the money option is because the insurance value is very high for you. All right. In that case, the insurance value dominates the time value, which clearly dominates the intrinsic value because the intrinsic value is in this case negative. For options that are at or near the value, both of these matter. All right. Any questions? All right, let's look at number 19. Okay, so like we did earlier, these are the underlying data. These are the T-bill rates, and we are looking at, what is these are options that are expiring in 4 weeks. So anytime we talk about the appropriate risk-free rate when we're doing options, we want to, as we have discussed many times before, we want to use those interest rates with the same, approximately the same distance to maturity. So later on, when we do options that are that expire more in the future, if they expire a year into the future, then you should use T-bill rates that expire a year in the future. Okay, that mature a year in the future, not expire. So we're looking at options that 4-week maturity. So the strike price is given by here. You can see these are all call options. The strike price of options times 1,000. So the strike price is given here in F2. The underlying price at date of maturity I've taken it from the underlying data. The call price is equal to the bid price plus ask price, which we get from option metrics, and that gives us the call price in column J. Then, volume, open interest, not of much interest. So first thing is, one of the bounds that we have is that the call price is always less than or equal to underlying price. So then we say if J2 is greater than G2, then we say it's a violation, otherwise it meets the bound. How often do we see bound? It's always in the bound. Great. So those call prices are always being met. That bound is being met. Awesome. Column N is the T-bill annualized at date of price. So strike price discounted to date of price. Where is our strike price? Here on F2, we take e to the negative N2, which is the T-bill rate, e raised to the power negative R times B2 minus A2 is the number of days divided by 365. So B2 minus A2 divided by 365, that is 28 divided by 365, that is to say in number of years. Okay, you have to be very careful that you are discounting it appropriately. Okay, in this case, e to the negative r cap t, t is in number of years. So the number of years is N2, sorry, is B2 minus A2, which is the number of days divided by 365 times F2, which is the strike price. So strike price discounted to date of maturity is given in column O. Moneyness, G2 minus F2, we have done. What is the next bound that we have? Is call price is greater than or equal to moneyness. You should never, the call price can never be less than moneyness. And once again, the logic is something, if you want to see, you should look at it. So now let's look at this and you see, oh my goodness, there are actually some violations. That is to say, we actually find situations where the call price is less than the moneyness. How many do we have? 77 of 2072. That's the thing about dealing with actual data. We have all kinds of problems with actual data. They're not as neat as theory likes us to do. So that's why I've insisted on this in this course, that all of you need to get your hands dirty at all times. Understand that data don't always follow the rules of theory. So as you can see, but good thing is, it is 77 divided by 2072. So the percentage of violations is actually pretty small. Why are we getting these violations to begin with? And one of the reasons is that option prices are, what we are observing are option prices at the end of the day. These are not intraday options prices. So options can vary quite a lot during the course of a day, and that is not being captured here. So that's one of the reasons that we are getting these violations. So let's go back to it. Select all. Okay. Now, discounted moneyness is equal to underlying price minus strike price discounted to time of maturity. Discounted moneyness is not moneyness discounted to today. All right, please understand that. Discounted moneyness is not what it sounds like. It's not the moneyness times e to the power negative RT. No, it is equal to the G2 underlying price minus discounted strike price. So discounted moneyness is underlying price minus discounted strike price. That is the discounted value. The difference between these gives us the insurance value. J2 is the call price. R is the discounted moneyness. So J2 minus R2 is the insurance value. And that, according to the theory that we have talked about, should always be non-negative. Is it? Well, we do see sometimes that it is negative. So let's see, how often do we see them less than 0? And you can see over here, it's 154 of 2072. Do you see where the numbers are? How many times we get that violation of bound right at the bottom? Shing, can you see the number of violations?
Yeah.
Okay, good. All right. We're back to our insurance value. So what is the time value of strike? Equals F2 minus O2. That is the K minus present value of K, the strike price minus the present value of strike price. And given that it's a very short period, it's only 4 weeks, and the interest rates are very low, the time value of the strike is, tiny, just about 4 cents. All right. What is one thing that we talked about? Is call price has to be greater than equal to the maximum of the discounted moneyness and 0. How often do we see that happening? Wow, we see some violations. Let's look at the violations. 154 of 2072. How much is that in percentage terms? It's less than How much is it?
About 7.
Yeah, okay, thank you. So it's about 7%, which is, not that low. 7% is, can be significant, right? But it is what it is. We live with it. And that's what we talk about in terms of the bound that we are dealing with. Any questions? So these are the bounds that we are which brings us to the next set of slides of early exercise. Okay, so the decomposition and early exercise. Now, that's only true. This question only comes up if you're dealing with American options, because European options, there is no question of early exercise. You can only exercise a European option at time of maturity, but American option allows you to exercise it before and up to the time of maturity. Question is, when are you going to do it? So what if you want to monetize an American option? There are two ways of doing it. You can either sell the option or exercising the option. Early exercise means that the intrinsic value is realized, right? Whatever the intrinsic, intrinsic value, remember, underlying minus strike price, that is realized. Selling the option means the option value is realized. So when is, if the option value is greater than the intrinsic value, then there is no reason to exercise it. Other way around, if the intrinsic value is greater than the option value, then you exercise. Okay, it's purely a comparison between the two that gets you to when you should exercise it. So early exercise realizes an option's intrinsic value. So early exercise is suboptimal if the option value is strictly greater than its intrinsic value. So this is the interesting result, the next bullet point. For call option, if it is a call option on a non-dividend paying stock, early exercise is never optimal. Okay, let me repeat that. For a call option on a stock that does not pay dividends, early exercise is never optimal. However, with dividends, early exercise may be optimal. For puts, early exercise may be optimal whether or not dividends exist. Let's then look at go back to our data set. Remember, if the call price is greater than moneyness, call price is the value of the option. If the call price is greater than the moneyness, then you are better off holding the option till its expiry. Moneyness is what you get by immediately exercising it. So as long as the value of the option is more than the value of exercising it, you will hold on to it. So if call price is greater than moneyness, then there is no reason to have early exercise. Our theory clearly states that for a call option on a non-dividend paying stock like Facebook does not pay dividends, then there is no reason to have early exercise. So here we say, okay, if J2 greater than P2, that is to say, if the call price is greater than the moneyness, then you have no early exercise. Otherwise, you have early exercise. So let's see. Do we see early exercise? Yes, we do. How many? 77 of 2072. So that's about 3%. 3.5%. So in 3.5% of situations, our theory is actually violated. We do see early option being optimal for call options for non-dividend paying stocks. But 3.5% is a low enough probability. We won't worry about it. This is what is called the early exercise probability, which in Silicon Valley in particular is a big deal. for a lot of firms that are at the initial stages, which are being funded by venture capital, the way they compensate most of their initial employees is through giving them options. But this is the interesting thing. When options, if you have a call option, a large portion of call options actually get exercised substantially before maturity. And so there is a lot of theory behind understanding this early exercise probability. All right, so this here is a very good way of just thinking about when early exercise probability is positive. In theory, if there is a stock that does not pay dividends, then there is this call exercise probability on a call option should be exactly equal to 0. But we see in reality that it is often positive, and we need to be aware of that. Please do these similar exercises for all the bounds for put options. We do is put price lower than discounted put price. Look at the bounds and not bounds. Is put price greater than discounted? We look at the valuation and not valuation. Now, for put price greater than moneyness, this is where, now remember, there is no such theory for suboptimality of early exercise of a put option. So what exactly is the probability of early exercise of a put option? It is substantially higher than that we saw for call options. We saw early exercise here happening about double the percentage for a call option. And that can definitely happen. No reason why it shouldn't. So this is a way of looking through the early exercise probabilities and so on for call option and put options. So I'm going to close out of this file and go to a different. All right. Put call parity is something that I actually use a lot in my research. And so the publication that I have in the Annals of Financial Economics that came out late last year is about put call parity and its relationship to efficiency of markets, which I will talk about, not next class, but the class after that. Also in the book, that is one of your textbooks that just came out recently. I discussed this in a lot of detail, especially in a big data context. So this is a large part of my reputation as a researcher and a consultant is based on my work on put call parity. All right. So so it is, as I said, it's one of the most important results in all of option pricing theory. So so it relates the price of call options to otherwise identical put options, and you can go through steps as you if you're interested. Please go through this in a lot of detail. The logic behind it, the theory behind it. I'm going to focus more on the empirical side behind it. Okay. The first thing to think about this is the put call parity for European options, which is that the price of a European put plus the underlying equals the price of a European call plus the present value of the strike price. Once again, the thing to remember here, we'll see later, for European options, it is an equality. Price of the put plus price of the underlying equals price of the call plus the present value of the strike. That is the put call parity for European options. For American options, it is substantially more complicated. It turns out to be an inequality. Okay, it is equal to the price of the call option plus the present value of the strike is less than or equal to the price of the put option plus the underlying less than or equal to price of the call option plus the strike. All right. Once again, for a European option, it is equality. For an American option, it is an inequality with 3 different components. All right. So I'm going to now walk you through a couple of spreadsheets illustrating these. All right. Now, I'm going to now share with you the file number 21, which is a share of options on the Standard & Poor index. Now, as I've mentioned to you, all options on American equity sold on American markets are all American. However, options sold on American indices are typically European options. So first, in order to understand the put call parity for European options, we are going to do it for Standard & Poor options. All right. So first we have the SPX underlying, which we have obtained from Yahoo Finance, because one thing that we do not get from CRSP is the actual prices, the open prices, high prices, low prices, close prices, etc., of the S&P 500 from CRSP. CRSP will give you the returns, but for options, we need not only the return of the S&P 500, we need the actual prices. So this here, the SPX underlying, is actually from Yahoo Finance. So from put call parity, I've here talked about, we're looking at the dates are in 12/27/2017, expiration date about 28 days. So the T-bill rates that we are interested is 4-week maturity. There is worksheet number 20, file number 20 actually does this for longer maturity for 2 years, and in which case you should check it that we will do it. Actually, you know what? I'm going to walk you through that in just a second. Okay, so this is file number 20, where we have options on Facebook that are expiring options on Facebook that are expiring in 740 days. So they're like 2 years into the future. Options that are expiring 2 years into the future, when we do all kinds of calculations on options that expire 2 years into the future, what you need to do is, in this case, use the Treasury constant maturity for 2 years. What you need is a risk-free rate on Treasuries, on the US debt that matures in 2 years. Okay, so when we do all these calculations, when we see in order to do all the discounted values, the appropriate rate is the 2-year T-bond. So because this is the duration of these options is 2 years, the appropriate discounting is done using the 2-year risk-free rate. Okay, so that is something that you should always keep in mind, that the appropriate risk-free rate depends on the horizon of the particular instrument you are looking at. So I'm going to close out of this and go back to the SPX option that I was looking at. As I was telling you, this is so this is because it matures in 4 weeks. So I'm going to use the 4 weeks T-bill rates. All right. So let's quickly walk ourselves through this. Duration of 28, different strike prices, the underlying price. We will look it up from the SPX underlying price at different dates. Call prices, we get them from, so the way I've set it up is I've taken the call prices and matched it against the put price. So the put price here is read from the put options database. The T-bill rates is what we get from the T-bills or appropriately annualized. So the discounted strike price is this. Now, remember what we did earlier when we did the put call parity for European options is a price of the put plus price of the underlying is the left-hand side. The right-hand side is the price of the call plus present value of the strike. So in order to get the left-hand side is price of the put, sorry, the price of the call, J2, price of the put plus underlying. Price of the put, J plus underlying H2. So J2 plus H2 is the left-hand side of that inequality. And the right-hand side is the price of the call plus present value of the strike price. Where is the present value of the strike price? Or the discounted strike price is in L. The put price is, so the call price is in I. So the right-hand side equals call plus discounted strike price. So that gives you the right-hand side of this inequality. So M2 and N2 in under put call parity for European options, these should be equal. So let's take the absolute difference, which is the absolute value of this subtracted from each other. So we see in principle, these should be all equal to 0, but they're clearly not, because that's the funny thing about data. They're never exactly equal to the same. However, then we say, well, let's normalize it divided by the underlying strike price. And then we see the numbers, the percentage numbers are actually pretty tiny. What do we see? From 0, obviously, the highest that we see is 0.172. So the percentage numbers are very low. So we can see that the put call parity is holding substantially, okay, for European options. Now let's go to, in order to understand how this works for American options, let's go to file number 22, which is for Walmart. Walmart is an American equity, as we know perfectly well. And we are doing this for American, as we said, options on individual American equities is always American options, the ones that are sold on markets in the US. So this is what we are looking at. So what is the, so duration of, I'm taking duration of 100 days, all right? So, so strike price times 1,000. So F column gives you the strike price. The underlying price at data price, we look up, we take it from the underlying data. What is the T-bill rate that we're looking at? So these are options that mature in 3 months, sorry, in 100 days. So the approximate T-bills that we need to be looking at are the 3-month maturity T-bills. And then we annualize it, and then, so money net is, as we discussed before, the underlying price minus the strike price. The call price is something that we are getting from the call option, just as we have discussed before, from the call options data set. Put options, are we getting it from the put options data set? doing the VLOOKUP. The present value of the strike price The present value of the strike price is given by e to the power negative O2. O2 is the risk-free rate times B2 minus A2, which is the number of days, divided by 365. Remember, as I mentioned to you, e to the power negative RT. T has to be in number of years. So you take the number of days, B2 minus A2, divided by 365 to express the number of days in terms of number of years, times F2, which is the strike price. So the present value of the strike price is given in row P. Walmart does give dividends. So we calculate the present value of dividends during this period from the underlying data given by the dividend cash amount. Given that there is a dividend paid on August 9, 2017. So we have to take a present value of that dividend, just as we have discussed before. All right, now going back to the put call parity for American options. Remember, it is an inequality. Please have this in front of you. The left-hand side is call plus present value of strike less than or equal to price of put plus underlying less than or equal to call plus strike plus present value of dividends. So this is an inequality with 3 parts. So there is, when we go back to our Walmart data set, so we have the left-hand side of the put call parity equals the price of the call plus present value of the strike. That is the left-hand side. The center of the put call parity is the price of the put plus underlying M2 plus H2. It's price of the put plus underlying. And the right-hand side of the put call parity is equal to price of call plus strike plus present value of dividends, which is equal to column L plus column F plus column Q. So these are the 3 parts of the inequality: left-hand side, center, put call parity. So center minus left-hand side equals S2 minus R2, and then right-hand side. Remember, these are inequalities, so using absolute values won't work. We want the left-hand side is less than or equal to center, which is less than or equal to T. So if our theory holds, center minus left-hand side should be greater than or equal to 0. So column U should always be greater than or equal to 0. Column V should always be greater than or equal to 0. So what kind of variations do we see? So center minus left-hand side, yeah, we do see some negatives. And that is, as I mentioned, a large part of my research is exactly this. So let's look at less than or number equal to 0 is I take this deviation from put call parity. Here you can see. Can you see at the bottom of the screen, 124 of 619?
Yeah.
Okay, so that's the percentage, and that's actually not a terribly small percentage that we see. So that's about 20% of deviations from the center minus LHS. Now remember, this holds only if, even only if the market of option underlying cash, this entire ecosystem is efficient. So, which is not surprising that there are these deviations, because as we will see in the last class of this course, and which is a large part of my research and consulting, is about deviations from perfect efficiency of markets. So this is not surprising that we get these deviations. So what about the other inequality? So we see again there are deviations. In this case, for the right hand side minus center, the deviation is actually much lower. It's about 1%. Interesting. The fact that these two, the center minus left has a much higher percentage of deviation than the deviation between the right minus center is a very interesting observation. What that means, well, that requires a lot of deep thinking, which I'd urge you to do, but at this point, let's not worry about it. So what this shows is when we have under the theory of perfect efficiency of market, this put-call parity for American options, which is a three-part inequality, should hold, but we see deviations from it. And the deviations are first because of deviations from market efficiency, and also because of what we discussed earlier, is that the data that we are using here for options are daily data, whereas option prices can vary a lot between during the course of a day. So if we were using intraday data, which is much more difficult to handle in something which I intend to do at a later point, we will see a different nuance to it. Okay, so once again, deviations happen for many reasons. First and foremost is deviation from perfect efficiency. And the second is because the options data that we are using are daily data. The strike price data that we are using are, sorry, the underlying data that we are using are actually daily data. If we were to use intraday data, like we have seen from CBOE, or if we for options, and if we were to use intraday data for the underlying, as we have seen from TAC, then we could get a different measure of all this. All right, it's 12 o'clock. Let's reconvene at 12:15. Thank you. We'll talk to you soon.